Hello everyone and welcome to your Glassnode video report for week 39. I'm your host Checkmate and we're here on the 28th of September 2021. This week we're going to do a fairly interesting little deep dive on both the bull and the bear case for the current market structure. So there's a lot going on at the moment and it's quite interesting to unpack all of these different details and charts and really understand exactly what the underlying structure is of the market. So what we're going to look at on the bearish side of the equation is really what's going on in terms of the on-chain activity and the short-term holder supply base. So what we're looking for there is, are people actually using the Bitcoin network? And if not, is that telling us a bearish story? And the other side of it is, of all of the people who've recently transacted and their cost basis is fairly recent memory, are they probable to actually spend their coins and sell into that pressure and create additional sell side? Or are they actually going to hold strong? So really assessing what's going on there in terms of the bearish case. But then we're also going to look at the underlying more bullish structure, which is the hodling and the accumulation that appears to still be in the market. There's this undertone that can take a little bit longer to play out these supply dynamics. However, if we run this experiment forward long enough and these trends continue, we don't get some kind of major shock that changes things, it still paints a relatively constructive long-term path for Bitcoin. So we're going to look at both sides of this case and we'll run through a couple of charts in a little bit more detail this week. So let's get started. So here we are in Glassnode Studio. We're looking at our week 39 on-chain dashboard, and we can see that we've had a couple of red weeks. And what we've really traded down from today is about 48,000 down to about 39,000. So it's been a bit of a volatile week to the downside. And at the time of writing, we're roughly trading around 42,500. So really what we're looking at the moment is this starting to set up a potential lower high and actually starting to roll over? What do the fundamentals tell us about the bear case? And then the converse of that is, what do the fundamentals tell us about the bull case? So what we're going to start with on the bearish side of things is the on-chain activity side. Now what we have plotted out here is our number of transactions and then the entity adjusted version. So this is our raw data, and then our entity adjusted then runs it through the Glassnode filters and algorithms, which removes all the internal transactions and wallet management by exchanges and various bits like that. So it's looking at a more economically meaningful or clean data set, but we can see similar trends across these metrics. So we've got a number of transactions, we've got a number of active addresses and active entities. And this is trying to provide us a bit of a proxy for what's going on chain. And I've applied a 14-day moving average across these just to really see the big picture trend. And we can start to see if we're getting some kind of downtrend, uptrend, what it's all pointing to. Now, in a theoretical environment, you are going to see more active addresses, more transactions, more people coming into the network, and just ultimately more interest as people come in during bull markets. And we can see this in our active addresses and active entities. During the bull market following the March 2020 sell-off, we saw a very, very significant rise in active entities, in active addresses. We maintained a fairly stable baseline of transactions, and you can see that on an entity adjusted basis, that continued to climb as well. And note that most of these metrics peaked in and around January or February. That was really the absolute zenith or the height of that new interest that was flooding into the system. We then started to plateau. We had our May sell-off where we lost 50% value, and we've essentially seen a reduction in the amount of activity that is actually not too dissimilar. If we look at our entity adjusted metrics, in the number of transactions, it's actually lower than the pre-bull phase. Number of active entities is just slightly higher than our pre-bull phase. This was between 200 and 250,000 per day, whereas here we're trading just above 250. So what we're really seeing here, same for active addresses, we're trading just slightly higher than where we were in this pre-bull phase. Now, what we can actually do is jump across to our number of active entities on the larger picture. Now, what I want to highlight here is we've essentially seen in the early phase, and I'm calling the early phase up to around 2016. This was really Bitcoin's growing up phase. You can see there's this rising view of number of active entities, people that are on the chain, people that are transacting, moving value around. And really it was as we moved into the 2016 and 17 bull run that we started to see some fairly large scale interest coming in. These were very, very early adopters, and it was really Bitcoin's growing up. And what we've seen since that point is two different characteristics. So from 2016 onwards, we've essentially seen at the early phase of this bull, and then during the 2018 bear market, 2019 bear market, 2020, you can see there's this kind of lower bound channel, and actually not dissimilar to where we are at the moment, there's this lower bound channel of kind of baseline. It's still rising over time. You can see that we've got this steadily growing network effects over time. So the user base is growing, but during bear markets, it's distinctly less than what we have in bulls. So the 2017 bull market, we saw this very, very rapid rise, new people coming in, there's excitement, there's hype, the media's on board, and we can see this in the on-chain data. More and more people coming on board, more activity and more hype. Now, following that, when you get a significant correction, that you went to a bear market, we generally fall back into this channel down the bottom here. And it's showing that there's this residual interest. These are really the hodlers. This is the smart money. This is essentially the new speculators that are coming in. With each cycle, you get some people that come in, the market sells off, then those people leave, but some of them stick around. And what we end up with is this gradually growing baseline of holders. And that's really what this metric is telling us. And we can actually jump across to our second metric, which is our entity's net growth. And what we're looking at here is a very, very similar type trend. So net wealth, that previous metric was active entities. How many people are actually transacting on a particular day? What we're looking at here is what is the growth rate of that. So at some point, some entity will sell all of their coins and they leave the system, and some people will come in. So we look at the difference between the number of entities that are created on chain and the difference between that and the number that are leaving. So if you look at it on a net value, are more people coming in than leaving, or vice versa? Now we can actually see this. Note that during the very early days, the 2011, 2012, 2013, very, very low amount of growth. We're talking about 300, 400 new entities per day. As we start moving into the 2014 bear market, note that we kind of established this second floor. We're up about 10 times, 3,000, 4,000 entities per day. So this is essentially forming a new base of hodlers. Now what we then see is we have our bull market, the growth rate explodes higher, then collapses back down, but not quite to this previous floor level. We've essentially established this new baseline level through the 2018 into the 2019 and then into 2020. We established this new floor between somewhere around 7,000, 10,000 entities per day. So this is really showing us this new hodler floor. We've then had our 2021 bull market, which again brought new people into the space. And you can see we're actually establishing a new floor, or at least the early signs of it, establishing a new floor up here around 12 to 13,000. So you can see that in each cycle, we're really adding new entities. The growth rate is continuing to expand. And the important part to remember is that this is at the same time that supply is actually slowing and slowing down in terms of the mining rate with a halving. So we've got more people coming on board with each cycle and sticking around even after sell-offs. But we're also seeing the supply rate issuance starting to get cut in half with each cycle. So it's a very, very interesting dynamic, and really it is quite unique to Bitcoin as an asset. So really the high level takeaway from a lot of this is that what we've seen is this explosion through the bull, a cooling off period since May in particular, but even since February indeed. And we're essentially sitting at this level which is slightly higher than where we were. And this generally speaks to most of what we would call tourists or new retail, new speculators, people who are really here for the bull market and then have lost interest, have more or less left the building. And we can see this on chain. What we're looking at this case is really the people who are willing to stick around. Now, that in many instances is kind of the definition of a bear market, where you end up with the speculators leaving, people are essentially losing interest, and you have the hodlers that remain that are essentially that buyer of last support. So what we're seeing is that there's that smart money base of people who are here, rain, hail, or shine, and that is at a higher level than where we were previously, but it is certainly at a fairly relaxed level compared to where we were trading in the bull market. So that's kind of painting a little bit of a bearish case that, you know, some of those on-chain dynamics are pointing to the fact that most of those retail speculators have left the building, and we've essentially got the hodler base that remains. And the question is, how likely are they to hold the line? Essentially, can they put enough bid support under the market to push us higher? So a key question to answer that, there's kind of two sides to the equation. The first one is we have what we call the short-term holders. And these are coins that are younger than 5 months. And the reason that these are relatively important is because they capture coins that recently moved, and people generally assign psychologically a cost basis. What it is, their cost basis when they purchase the coins, they're more likely to react. Let's imagine that price suddenly moves away from their price, their buy price, to the upside or the downside. There's an immediate feeling to want to take profits or lock in the losses because you think it's going lower. So the longer that a coin is dormant, the more likely it is to stay dormant. And that's when it transitions to the long-term holders. So we're going to answer this from two different angles. The first one is, are short-term holders kind of in a point of stress? Are they likely to actually sell their coins? And this is where we look at things like our percent supply in profit and our percent of entities in profit. So in previous newsletters, we looked at price as it rallied out of this corrective zone. So we had this large scale accumulation period from 29,000 up to about 42,000 was our highs. And we saw this fairly significant accumulation pattern. And it's hard to tell what kind of accumulation is going on until price moves out of that zone. Now, as price moves out, we can suddenly see how much of this supply moved to becoming in profit. And what we saw is that there was about 20% of the supply, or just shy of 19.8% of the supply, was in profit by the time we hit 52,000. So that's really demonstrating the volume of coinage that was actually purchased during this period of time as we see price move away. Now, what we've since seen, if we look at this on a percent entities in profit basis, we saw that be about 16.8% of entities. Now, this will include both accumulators during the correction, accumulators on the way up, and also people who purchased in a similar price range back here in January and February. So what we saw was a 16.8% of entities that returned to profit, and we've since seen about a 10% or 9.8% correction of that. So if you think about that, that's 16.8%, and then we've had a 9% retracement. That's something on the order of about 58-60% of the entities within this zone who are largely short-term holders and thus more likely to react to price. 58% of those people, or those entities on chain, are essentially now underwater on their position. So they've seen their position go into profit, and then they've essentially seen the market pull back away from them. So this potentially creates a level of stress in the market, and it could potentially trigger some of those shorter term holders to sell. Now, what we can also look at is the short-term holder MVRV ratio. Now, MVRV stands for market value to realized value. So what we're looking at there is the spot price versus the realized price, which is the on-chain cost basis. It looks at all of the short-term holders in the system, and it evaluates what was the price at which their coins last moved. And we can think about like their cost basis. Now, when the MVRV trades at a value of 1, which you can see in this dashed line here, that's essentially saying that price is trading at their cost basis. Now, what's quite interesting, note that during bull markets, let's take the 2016 bull, price consistently comes back and retests a value of 1 before bouncing. So what we're essentially seeing there is the market is finding value at the short-term holder cost basis, buying the dip, and then we're seeing a rally higher. People then sell, we get a correction back down to that cost basis, people again step in to buy the dip, and the cycle more or less repeats all the way into our final top. Now, once we move into a bear market, we actually see the reverse. As price corrects back to the cost basis, people are happy to just sell to get their money back. So we essentially see overhead resistance and sell side come in, and that then creates the bear market dynamics. It comes back, it retests the cost basis, short-term holders sell, and we essentially get this longer-term period of time below a value of 1, which is saying that short-term holders are essentially holding coins that are underwater or held at a loss. Now, 2019 into 2020 was a fairly volatile period where we actually bounced up and down around this level. 2021, we saw that we had this bull market where we essentially had a large springboard off the retest, had our entire bull market into the top. May was a period of time where we actually fell down below, and we were seeing that short-term holders were essentially holding coins at a loss. And note that we've broken above, returned to profitability just briefly, and now we're back to retesting that cost basis. And this is really going to be the ultimate question. Are short-term holders going to behave as if they're in a bear market where we essentially see that cost basis and people take their money out of the system, sell their coins at their cost basis, and potentially create that further downside? Or are we going to see more of a bull market type behavior where this is actually a retest, people step in and see value, and then we get the rebound? And this is where we get this very interesting dynamic, and it's why we have to then answer the second part of our question, which is what are the hodlers doing? So that's the short-term holder side of the equation, and they would ultimately be the higher probability for creating that sell side. Now, that doesn't mean that long-term holders won't step in and also spend their coins. That's also a risk. But this is where we're going to assess the probability of that. And are we actually seeing more short-term holders who are buying stepping in for the long term, and they have the likelihood of becoming long-term holders? So this is where we're looking about this transition set. We know that short-term holders may sell, but are they likely to? This is where we're going to assess this part of the problem. Now, we've got a number of metrics on the screen here. On the left, we've got our coin days destroyed 90. Now, this is looking at a coin day for every single coin in the system. It will generate 1 unit of day, or a coin day per day. So the entire circulating supply establishes 1 coin day per day. Now, some of those coins will be spent. Some of them may be 3 years old, some of them may be 24 hours old. So that may be 1 coin day for the 24-hour-old coin, or 3 years worth of coin days. So what we're looking at is how much over the last 90 days, so the last 3 months, and noting that the last 3 months is entirely within this corrective pattern, how much coin day is being destroyed over that period of time. Now, high level, as we trade higher with this metric, you can see that this happens during bull markets. This is because older coins are coming back to life. Smart holders who purchased during the bear market previously are essentially selling into market strength and realizing profits, and you get more of these old coins being spent, which ultimately puts the top in. When we have a downtrend in this metric, it's actually saying the opposite. Fewer coin days are being destroyed over time. It's showing hodlers are actually preferring to hang on to their coins, and we're seeing fewer coin days being destroyed. So it's actually showing us the converse. We're actually seeing more of this hodling behavior rather than distribution behavior by the older hands. So that's our first signal that the hodlers actually do have a level of strength and high conviction. Now, on our long-term holder, short-term holder profit and loss, in the blue is all of our long-term holders. So we're looking at between 0 and 100% of the total supply. Blue are long-term holders, dark blue being in profit, light blue being in a loss, and red is the opposite for short-term. So short-term holders in a profit, short-term holders at a loss. Now, what's very interesting is that we're currently at a level where long-term holders own just more than 80% of the total supply, and short-term holders own 20%. Now, these are actually all-time highs and all-time lows respectively. So we can actually see that long-term holders currently own more supply than they've ever owned before. Short-term holders, conversely, own as little supply as we've ever seen before. Now, generally when we hit these levels, it's coincident with a bear market, but generally with later stage bear markets, because we've seen that accumulation come in and we're getting closer and closer and closer to a potential supply squeeze. So it's telling us that yes, there's certainly bear market characteristics, which aligns with what we saw with our activity metrics. However, there's also a sign that maybe this is actually not quite as grim as it may look. Sure, it may take a couple of weeks to play out. It may take some time. However, that underlying accumulation seems to be in play, and we can see this in our coin days destroyed metric and the all-time high in long-term holder supply. Now, we can also see this in our highly liquid and our liquid supply. So at a very high level, highly liquid supply are coins that are essentially on exchange. They can be bought and sold at the click of a button, and they're really not able to be classified as HODL. They're easily to change hands. Now, when a coin is withdrawn from that supply, from an exchange, we don't know if it's going to get sent back immediately. Most of the daily transactions are actually fairly young coins. But the longer that it stays in an investor's wallet and stays dormant, the more likely it is to become illiquid or HODLed. So highly liquid are coins that can be sold at a click of a button. Liquid supply are those that are in the process of transitioning from highly liquid to illiquid, and then illiquid is essentially when a coin has been outside the system and essentially in a hodler's wallet for an extended period of time, and it's therefore quite unlikely to be spent. So we can actually see this dynamic. Highly liquid supply, and this is the same for exchange balances, has been in a fairly strong downtrend since March 2020, which was actually the peak in liquid supply, highly liquid supply. We saw an inflow during the May sell-off. Hodlers started to reaccumulate, and now we're seeing the major outflows, and we're actually back down to multi-year lows for highly liquid supply. On the liquid supply, we've got a similar trend. It's been largely trading sideways, and then as we move into the 2021 bull market, we really had a significant amount of coins flow out of exchange and out into that transition into that liquid state. We then saw an inflow of coins during the panic in May, so very, very similar behavior. Most of those have then been reaccumulated, and we're still seeing this overall longer-term downtrend. And on the big picture, our liquid supply is in a fairly substantial downtrend. It has been since about 2016. So between these two highly and liquid supplies, we have downtrends that are in place, showing that more coins are being sucked out of exchange, moving into investor wallets, and there they start to transition to becoming illiquid. And we're seeing this fairly strong increase over time. You can see the illiquid supply is at an all-time high. We've essentially, as the coins were spent and flowed into the exchange, so we got a reduction in illiquid supply or a rising in liquid supply. That's now been reaccumulated over the last couple of months, bounce, and this is now trending back into the upside. So we are seeing these strong and constructive supply dynamics, but it's important to keep in mind that these things can take a little bit of time to play out. Now, we can also really confirm this with our exchange net position. So we can actually see that we've seen fairly substantial outflows, particularly over the last couple of weeks, certainly following our correction. So as the market rallied in August, we can see the market started to feel a little bit more confident about the direction, and we've moved back into this regime of outflows. And this is very different. March 2020 really was a bit of a tipping point. Prior to March 20, inflows dominated. We saw more coins flowing into the exchanges than not. Following March 2020, we've essentially seen a regime of dominant outflows. Short of the May period where we saw some inflows, most of these coins have been coming out of exchange and moving into investor wallets, which again is painting this fairly high conviction picture that hodlers are really here to stay. And last but not least, we want to touch on the Lightning Network. So it's been a pretty exciting week for Lightning. We've essentially seen Twitter's implementation, and we're continuing to see the El Salvador movement. We're seeing more and more people coming on board with various wallets at a national level, which is just truly an extraordinary event. And we're really pleased to have launched Lightning Network metrics to coincide with all of this. And what we can see is that our Lightning Network capacity, which is the number of coins, is about 2,904 coins. So almost all of these metrics are at all-time highs. So we really are seeing a fairly explosive growth in many of these metrics. So our capacity continues to rise. And note that 23% of all of this supply that's come in, being locked into the Lightning Network channel capacity, has been in September. So this is all happening fairly recently. The number of network channels is now about 73,000 channels, so that's also continuing to rise. You can see all of these patterns are more or less going parabolic at this point. The mean channel size, this is the average number of coins in each channel. So you can see that during the 2020 and early 2021 phase, this is kind of the bootstrapping phase, it was somewhere between 2.5 million and 3 million sats. And we're now up around 4 million sats, or just pushing above that. So the average channel size is continuing to increase. And you can see that this is more or less aligned with this same acceleration phase and really demonstrates a growing, almost a trust. And as people use the network, they become more familiar with it. As people get more familiar with these tools, they're willing to lock up more and more funds and larger channels. The demand for these larger channels starts to increase, and it really starts to make its own. We can see that our number of nodes is now up above 15,000, so that's continuing to grow. And similarly, our median, so this is the typical channel size, is up around 1 million sats. So it's pretty typical for median values, which is kind of the most of. And we generally see these fluctuate around these kind of round numbers. So 500,000 sats, 600,000 sats, 1 million sats, whereas our average will fluctuate a lot more. So it's quite interesting to see. I'm really excited to see how Lightning Network grows over the coming weeks and months. So certainly check out on our dashboards page, there's a preset section for Lightning Network metrics. And we're certainly going to be rolling out more of these as they come to fruition. So thank you for tuning in. Be sure to give us a rate, review, and subscribe. And I look forward to seeing you in the next week. Cheers.